Hi everyone. In this business topic video, we're going to take a look at a really important part of financial ratio analysis, and it's a concept that's called gearing. Now, gearing is a funny sounding word, so it's important to try to remember what it's trying to achieve, what it's trying to represent. Gearing is all about how a business is financed, and in particular it considers the relationship between the amount of finance in the business that is provided by what's known as equity, otherwise known as share capital or shareholders' funds, compared with the amount of finance that is in the form of debt, for example, bank loans. And the idea of gearing is to try to measure the proportion of a business's capital that's provided by those two things, by equity or share capital and by debt. And there are two main ways of measuring gearing, but actually, to be honest with you, they both really try to achieve the same thing. So depending on which exam course or syllabus you're following, you may be required to know one or both of these two. Normally though, the one on the right there, the gearing ratio, is the more popular, the more common. But in this short video, I'm going to explain and illustrate both of the two main ratios, the debt equity ratio and the gearing ratio. But don't worry, both effectively try to calculate a very similar thing. I've mentioned that gearing is all about how a business is financed. What is the relationship between the different types of finance that help a business run along? The capital structure of a business is just that. It is the structure of the different types of finance that are used to enable the business to progress. And it essentially has two parts. It has equity. This is the finance that is provided by the owners, the shareholders of the business. And that is not just, of course, the share capital that they put into the business, the issue of shares, but also the profits that they retain within the business as part of shareholders' funds. That's the amount of funding that's put into the business by the shareholders, as well as the money they leave in there as retained profits, rather than taking it out as dividends. The other side of the capital structure of a business is the stuff that's not equity. It's called debt. And what this is sources of finance that are provided by external parties such as banks, which are in the form of debt. Bank loans being perhaps one of the most popular and certainly common forms of debt. But there can be other kinds of debt such as mortgages and debentures and other kinds of long-term liabilities that the business has to pay back at some stage in the future and on which it normally pays interest. Now, let's just have a look at a brief and simple example of what we mean by a capital structure and how they might differ. So on the screen here, we have some summary information extracted from the balance sheet of a couple of businesses. And let's take a look at business A to start with. So let's have a look. It's got a total capital here of £1 million. The columns are in thousands of pounds. So it's a total capital of £1 million. And that comprises some share capital, which I've labelled A, some retained profits, which, as we've seen, is part of the equity structure, 300,000. And it's also got a bank loan, which I've labelled C, of £200,000. So if we add those together, if we add together the equity elements, which is share capital plus retained profits, that gives me £800,000 worth of equity. And the only debt in business A is the £200,000 bank loan. So total debt is £200,000. Now let's compare that with business B, which also has capital of £1 million, but it's a slightly different structure. The share capital and retained profits together are £400,000. That's 300 plus 100. However, it's got a much larger level of debt as a proportion of its capital. It has a bank loan of £500,000 and also some other loan capital, which I've marked D, of 100. So if you add those two together, the total debt in business B is £600,000. So the key thing from this little example is to show that a business with the same amount of capital can have quite a different relationship between equity and debt. And if we were to use the first of the ratios to calculate effectively a form of gearing here, debt equity ratio, we can see how those numbers translate into different equity ratios. So for business A, the debt of £200,000 is just a quarter of the amount of equity. In other words, a debt equity ratio of 25%, whereas business B has a much larger proportion of finance provided by its debt, £600,000 compared with £400,000. Do the maths, and that comes out as a debt equity ratio, dividing one by the other, of 150%. What does this mean? Well, before we move on to the gearing ratio, just a few words on that debt equity ratio and that structure. Why would it be that a business would want a higher proportion of equity as part of its capital? Well, normally equity is associated with risk. It's a better source of finance for businesses that involve more risk. And the reason for this is that debt is not normally suitable for high-risk businesses because you've got to pay the debt back and you need to pay interest, whereas equity, there's a higher level of flexibility there in case things go wrong with the business. So you normally find higher equity in businesses that have greater risks, in other words, or for example, startup businesses, but also where the business doesn't want to have to be under the thumb of the debt providers, where it needs some flexibility. However, it's also the case that a business may want to have a high level of debt in its capital structure. In other words, have a high debt equity ratio percentage. And this has been increasingly the case in recent years in economies where interest rates have been very low. For example, in the UK for many years now, and I'm speaking in April 2016, for many years our base interest rate has been just 0.5%, which makes it very cheap to raise debt as a source of finance. And of course, debt is a good source of finance if the business is strongly profitable with positive cash flows, which makes it really easy to pay both the interest as well as to pay the bank loan back. So let's continue our journey on gearing by looking at perhaps the most popular, certainly the most common ratio around gearing, called the gearing ratio percentage or the gearing percentage. And it's a simple calculation. Normally you'll be given these numbers rather than having to calculate the numbers from the balance sheet. You take the non-current liabilities, that's the liabilities that the business owes more than 1 year, and typically that would be the bank loan that is owed over the long term, and you divide it by adding together the equity part of the capital structure and those non-current liabilities. In other words, the total capital invested in the business. And what you then do to express that as a percentage is multiply it by 100. So let's have a look at a simple example of the gearing percentage in action here. Again, two different businesses, similar idea, a nice summary of some information from the balance sheet that will enable us to use that calculation formula. Business C has non-current liabilities, which I've marked as A, of £200,000, total equity of £600,000. So if you add the two together, that's a total capital in the business, equity plus non-current liabilities, A plus B, of £800,000. Therefore, the gearing percentage is 200 divided by the total equity plus non-current liabilities of £800,000, a gearing percentage of 25%. Compare that with business D, which also has total capital of £800,000, but you'll see that actually the non-current liabilities, or the debt element of that, is much higher at £500,000. So we divide 500 by £800,000, and you could round that down to 600, but actually it's 62.5% as a calculation. Now, what does this mean? How do we evaluate gearing? Well, beware generalities about gearing. Normally the textbooks would say a gearing ratio of 50% or higher is said to be high, and that's fine, it's a useful benchmark. But of course, it depends on what type of business we're looking at. And normally it's said that if you have gearing of less than 20%, 25%, that is low gearing. And of course, somewhere in between, I guess, is normal gearing. But of course, the most important thing is this depends entirely on what the business is trying to achieve, what the business's performance is, and also typically what industry it operates in. There are some benefits of having a high level of gearing. One being, debt is cheap. It's a very cheap source of finance compared with the kind of returns that shareholders often look for, particularly in a time of low interest rates. And of course, the other benefit of having a high level of gearing is that it means the shareholders have invested less capital or have kept less capital of their own in the business. They've had to invest less. And high gearing is perfectly acceptable. In fact, it's a definite benefit for a business if the business has strong profits and strong cash flows, which make it easy to finance the debt, to pay the interest, and when the time comes, to pay the bank loan back or the debt back. Many businesses with strong cash flows and strong profits have a high gearing percentage, and it's simply not a problem for them. However, there are some business benefits of having low gearing. And I guess the most obvious, which I'm sure you can appreciate, is that if you don't have lots of debts, there's less risk that the business will fail because of those debts. It will fail if it's unable to repay the interest or pay the bank loan back. And of course, then in that situation, the holders of the debt, the bank or whoever, effectively calls the shots. Well, if you've got low gearing, the debt providers aren't in a very strong position. And of course, another benefit of low gearing is that if you do decide that you need some extra debt in your balance sheet or maybe to finance a project, you've got the capacity to add some without significantly increasing the gearing ratio. There we go, guys. That's just a brief introduction to and an explanation of this important financial ratio called gearing.